I'm finishing up the last part of the reference guide to regulatory compliance within subsection 2 credit, advisories on subprime, predatory and subprime lending. I'm in the guidance on non-traditional mortgage product risks, which includes loan terms and underwriting standards of qualifying borrowers. These standards should address the borrower's capacity to repay when the payment increases, the standards for potential payment shock, analysis of the borrower's ability to pay at a fully indexed rate, and avoidance of over-reliance on credit scores as a substitute for income verification. Number 2, under the guidance for non-traditional mortgage product risk, is being covered up by my dog's face. Hold on, babe. Excuse me. Sorry. Collateral dependent loans. Avoid loans where the borrower is required to sell the collateral for repayment. Risk layering is another loan term and underwriting standard to be the guidance includes as reducing risk, and that risk layering involves loans with less documentation or simultaneous second lien carrying more risk. Institutions should mitigate risk layering with higher credit scores, lower loan to value ratios, mortgage insurance, and other credit enhancements. Fourth, under the guidance for non-traditional mortgage product risk is reduced documentation, adding to the risk of a mortgage loan, in which case institutions that rely on reduced documentation in the credit underwriting process and don't necessarily obtain income and credit verification and use reduced documentation should be subject to clear policies that require more documentation when the credit risk rises. Fifth, under the guidance for non-traditional mortgage product risk, as simultaneous second lien loans are considered to increase risk, and that decreases the owner's equity, and that these loans should not have a payment structure that allows for negative amortization without significant risk mitigating factors. Introductory interest rates are another risk of non-traditional mortgage products, and lenders should be aware that interest rates increase the likelihood of payment shock, and institutions should take this into consideration when setting the rates. Lending to subprime borrowers, as they are from time to time targeted by lenders, increase risk of non-traditional mortgage products, and that would make lenders, a guideline for lenders is for them to adhere to interagency guidance on subprime lending to ensure that they do not engage in predatory practices. Non-owner occupied investor loans are also a risk that guidance recommends that banks qualify borrowers on their ability to pay over the life of the loan. Loan terms also should include appropriate loan to value ratios and take into consideration potential negative AM. Page 28, that's so difficult, is the last risk of underwriting, considering extended periods of vacancy and the variability of payments for your investment, your property, non-owner occupied investments. Portfolio and risk management practices recommended under the guidance for non-traditional mortgage products is policies, controls, secondary market activities, management information and reporting, stress testing, capital and ALLL, and consumer protection issues. This is actually all I have to get through to pick up where I left off under legal risk. So within the portfolio and risk management practices, banks should have policies that set acceptable levels of risk through operations and accounting practices, and state limits on risk layering, and set growth and volume limits on risk types. If the institution has a concentration in the non-traditional mortgage portfolio, the institution should have well-developed monitoring systems and risk management practices, and should monitor the originator and key borrower and portfolio characteristics. For controls, the institution's quality control, compliance, and auditing procedures should focus on the mortgage products with the highest risk. Third-party originations. If third-party originators are used, the institution should perform due diligence and institute oversight procedures. Monitoring procedures should track loans by origination and key borrower characteristics. For portfolios that are involving the secondary market, the secondary market risk management practices should be commensurate with the nature and volume of mortgage activity. Comprehensive formal strategies for handling risks should be implemented, including a plan for handling reduced demand in the secondary market. Management information and reporting under the guidance for portfolio and risk management practices involve reporting systems that allow management to detect changes in the risk portfolio of the risk profile of the institution's portfolio. Information should be available by risk layering, loan type, underwriting characteristics, and borrower performance. Portfolio volume and performance should also be tracked against expectations. Stress testing that institutions perform should include sensitivity testing on their portfolio to identify and quantify events that will increase the risk in the portfolio. Capital and ALLL should be commensurate with the risk characteristics of the non-traditional mortgage products. The ALLL should be established based on the risk of non-traditional mortgage portfolio, and the institution should segment the portfolio to similar risk characteristics in order to appropriately establish its capital and ALLL. Consumer protection issues that the agency is concerned with is when consumers do not understand the risks of payment shock and negative amortization, and their agency is also concerned with advertisements that emphasize the benefits of the loan that may not inform consumers of the true risks. Advertisements should be balanced and provide clear information to consumers.